How high will interest rates go in this quantitative tightening cycle? They're at 2.85% right now. Will they go up beyond 4% official cash rate? In this video, I'll share 4 reasons, 4 data points why they won't really make it to that level. If you're interested, carry on watching. My name's PK and I help people build passive income through the Property Investment Accelerator using data without needing a $15,000 buyer's agent every single time. And in this channel, we talk about property, the economy, and financial happiness. So the first chart I want to understand is the RBA rate hike cycles compared. Now the source for this is AMP, not the most reputable company in recent times, but the source is also RBA combined. Okay, so what we're seeing is this blue line, 2002 to 2008. That was a really elongated quantitative cycle, quantitative tightening cycle, okay? It took 70 months from the first rate hike to the last rate hike. But you can see that they were gradually, only very gradually increasing, and that led ultimately to the GFC, which I'll get to in a second, and whether we can expect another one. That was one version. Another is 1999 to 2000, very sharp quantitative tightening cycle, which led to the dot-com bust. So it's unsurprising why tech stocks are getting hammered right now. 2009, 2002, 2010, similar story. 1994 was incredibly steep, and so is this 2002 one so far. Now note that we're almost at record tightening levels, okay? We're almost at that 3% increase that was experienced in 6 years, so in 02 to 08, and almost there in comparison to 1994. All right, so that is some context, but more, maybe almost half a reason why you can expect interest rates not to go up too much for much longer, but really good to paint contextual color. Now, when it comes to property, or when it comes to the economy, it's not like just one data point that can give you a conclusion. We need to paint multi-dimensional data stories to really get us an understanding of what's going on. Here's another one, Australian interest rates on the rise. This gives you more context all the way back to the start of the millennium on what the official cash rate is doing. And you can see that the RBA cash rate, the average 3-year fixed rate, the average discounted mortgage rate, and the average standard variable mortgage rate basically go in the same direction, but they've never been hiked this quickly, this fast in a long time. Okay, so once again, you can see that we're not really at record interest levels, but the steepness of which they have climbed is remarkable, but we're not even up to those levels back in 2010, 2011, even 2012. So it's not like, the world is falling apart just yet. Now, I would say almost like the first real reason why I think interest rates won't cross beyond 4% or maybe even get close is that in unemployment, not just in Australia, but globally, unemployment lags what happens to interest rates. So like here, 88 or onwards, interest rate, the blue line, RBA cash rate, which is on the left-hand scale, it went up. As you can see, this arrow pointing out, and then it started to loosen. It started to ease. Interest rates started to come down. Now that is really interesting because it's only once they came down, well, in fact, a long time after they came down, a whole year, 1990 to 1991, when unemployment really started to go up. Now, this red line is unemployment as a percentage on the right-hand scale. So when interest rates were at their top, that is when unemployment was at the bottom, okay? The peak and trough were mirroring each other. And when they started to come down, that is when the unemployment rate went from 6% all the way up to a remarkable 11%. Now, what that tells you is that the RBA is not silly. It knows what it's doing is going to affect the real economy. It knows that it's going to push unemployment up from the high 3s, low 4s to the 5s, maybe even 6s. But that takes 6 months, that takes 12 months to occur. So if RBA was silly and increased rates at the same steepness relentless trajectory as it has been doing, then that's literally just taking a massive cannon and shooting the bejesus out of the Australian economy, because it's not waiting for that effect to occur. You got to wait. You got to let these things do their thing. There's a lagging effect, and so therefore interest rates will stop increasing sooner rather than later. Another reason in the RBA's toolkit, in their arsenal, and why they won't increase interest rates for too much longer is that household interest repayments relative to disposable income are already really, really high. Okay, so current rates 2.85%. If they continue to go up to 4.25%, my thesis is that it won't reach 4%. Let's say it does reach 4.2%. Now that is the second highest, okay, behind that 2006, 2007 period. That is the highest in terms of the disposable income contribution to interest repayments. Now that is going to stall the economy. That is going to mean a dent in aggregate house prices. Of course, there's always markets within markets, but the RBA knows what's coming if it goes too hard too soon. So I think that this cash rate, as it's going steep like this, it will kind of shallow out. Yes, it's going to become harder for households, but it's going to become harder at a shallower rate before it starts coming down. Now, the third reason is that, check it, AMP pipeline inflation indicator, all global inflation indicators have suggested inflation went through the roof in 2021, right? But they're all coming down, okay? Whether it's pipeline inflation or US CPI year on year in the red, it has started to come down. There is no doubt about it. And it will affect Australia as well. And then the last one, and perhaps the most interesting one, is that every time the Fed has increased interest rates in that part of the monetary cycle, it's always led to some sort of crisis. Okay, so there was the Pence Central Road crisis in the late 60s. There was a Fed's fund rate crisis causing the Latin American debt crisis. Go research about them, or if you want me to do videos on them to broaden your horizon, leave a yes below. Continental Illinois bank crisis, savings and loan crisis, Mexico, Orange County, tech wreck, subprime, that's the GFC crisis. Most people don't know, but interest rates are rising as house prices were rising in the US leading up to the GFC. House prices are going through the roof. Interest rates were also going up, so there's no direct correlation there, right, in the US or here. And that led to the subprime mortgage crisis. Last time, around 17, 18, there was trade wars. And this time, interest rates are rising. What's it going to lead to? There's going to be something's going to spill over. And when that spills over, that affects the global economy. That affects the whole world and then affects Australia, even though Australia's not the cause of it. So what does this mean? It means that RBA knows, once again, that when the US sneezes, Australia also catches a cold. Now, US inflation is up near 8%, UK, Europe inflation is up near 10%. We here in Australia only at 6 or 7%. Therefore, we don't need to do much because we are catching other people's colds. They have a bigger problem. They will tightening their screws so much more than we need to. And because of them tightening, our screws will automatically tighten in terms of sentiment, business spending, capex, consumer sentiment. You're already seeing it without the RBA needing to do much, okay? So it's like other people do the RBA's hard work for them. Therefore, our interest rates don't need to go up as much because they're affected by others anyway. Now, what does this all mean? It's like, cool, good thesis, PK. Well, what does it mean to property? Well, what it means to property is that smart investors realize that the majority of the pain is over. Most of the interest rate rises are behind us. And so therefore, as Warren Buffett said famously, be greedy when others are fearful and be fearful when others are greedy. Right now, most people that are uneducated are super fearful, but those who know what they're doing are greedy because they realize everyone else is fearful, but most of the pain is behind us. And this is evident in what's your next move within the next 12 months, as surveyed by API magazine. Most people, in terms terms of transaction attention are saying 28%, they're saying we want to buy, okay? 11%, less than half a cent we want to sell. So even though the media is painting one story and you might be swallowing that, right? The reality based on survey intention is the opposite of what the media is saying. Most people are still getting their skates on and buying. And where are they buying? Predominantly their intention to buy is in Queensland, followed by WA. Now, if you've watched my videos, maybe the last 50 videos, you'll know exactly why those states, those cities, and particular suburbs are the most ripe for continuing to boom in this quantitative tightening cycle. Yes. How do you feel about the state of the current Australian market? Actually, most people are positive. Now, you might be puzzled. You're like, I don't think my friends are. I don't think I am. I don't think my colleagues are. Based on surveys, most people are. Only half of them are negative. All right. So that is the reality. It's a good time to buy property if you know where, okay, and if you know how. This is not a good time to buy property if you want to throw a dart at the dartboard. My name's PK. To level up your knowledge and realize how to get the right dart, where to aim it, and how to throw it, level up your knowledge. I'll leave links below to my Facebook group, 25,000 amazing community members, and my podcast on Google, Apple Podcasts, and Spotify in the links below. Subscribe if you enjoyed it. Turn notification bell on. Give it a thumbs up, a like. And guys, I really want you to understand that the most important real estate is the 6 inches between your two ears. Invest in that before you do anything. And even if you're doing nothing, invest in that, because that is what will get you your return on investment over the long term. My name's PK. Catch you later. Bye.